Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are talking about, what people are sharing in the financial world. It'll be commodity based and or finance based that I will talk about, and I'm going to give you a bunch of my financial opinions. If you guys need any help with anything, definitely check out finding-value.com. You can use the word discount in the coupon code. I just released a midweek update, and we've got a 5 p.m. Mountain Standard Time Sunday Platinum question and answer session. So let's dive in here. Let's take a look and see what's going on. Again, you can follow me at finding_finance if you'd like. So Powell today, the banking system is sound and stable. At least that's what he said. But here's the thing, guys. Powell can't come out and tell everyone that the banking system isn't sound and stable. That's the only thing he can say. And of course, everything around it could be falling apart. And he's still gonna come out and say that to try to instill confidence and not get people to panic in the system. I think there was a movie, and I think it was John Cusack who said, "The time to panic is when they tell you not to panic." And that was when, I can't remember the name of the movie. If you know that movie, put it in the comments section below. It's like, I don't know. Can't remember the movie, but put it in the comments section below. He says, another one of America's biggest banks says it is looking for strategic alternatives. Shares are crashing. We've been talking about this for weeks. It's not over. So banks are still having problems, especially these smaller regional banks or whatever they are. And we're seeing a couple of these things dive bomb in the after hours. So we're seeing gold take off in the after hours. I don't know where it's going to go eventually. If it goes up, goes down, goes sideways, it sure looks really good for a move to the upside. But I'm not sure where it's going to end up in the after hours. But there are banks that are taking it on the chin in the after hours right now. Here's U.S. crude storage draw. Came in higher than forecast, minus 1.281 versus minus 0.68, our forecast. U.S. commercial crude storage is now below 2019. So here's U.S. crude storage, and the bluish dark line here that's solid is 2023. We're not near 2022, but we are drawing down our inventories, and we've been drawing down ever since March. It is expected by some analysts that we are going to have massive drawdowns coming this summer. And by the second half of 2023, we could have some very big deficits in the world markets. Something on the lines of 4 to 8 million barrels per day deficit. Something on the lines of that, 4, 5, 6, whatever it is. That's going to eat through inventories quite quickly. Now, what's going on in the short term isn't driven by the fundamentals of crude oil. It is driven by the financial demand for crude oil. When liquidity tightens up or when banks need to sell stuff, they may just liquidate whatever they got. Doesn't matter what. We're seeing regional banks have some problems. Maybe they've got oil futures, maybe they've got stuff in the markets, and they need to liquidate immediately. For whatever reason, for shortages of cash, and they're trying to shore up cash, whatever the reason is. That does not mean that the actual demand will get destroyed. We're going to have to wait and see what these inventory levels come out each week and see where the demand is going. If a demand exceeds supply by 5, 6, 7 million barrels per day, we are going to eat through commercial inventories like we've never seen before. We also have the least amount of strategic petroleum reserves in the world. That could propel us into a very large bull market in oil, irrespective of what's going on with a recession in America, if that deficit still exists. Recessions don't really kill a lot of demand for oil. Like I'm talking real barrels, actual demand for oil. So again, this is this is a very difficult spot to try to predict the short term in oil. You've got deficits that are here and persistent and coming in the physical markets, and then you've got the financial markets that are in disarray. So that's what the two forces battling against each other in these markets. It says, with all this risk feeling recessionary, systemically, and deflationary, all of a sudden, what happened to long USD? Question mark. As the dollar, as DXY at least, has dropped. I've talked about this. I did an entire clip on it. I said gold and silver miners could heat up here if we break the long-term downtrend line. This is a huge setup here for gold and silver mining companies in relationship to gold and a potential break to the upside. We're close, guys. And if we get this break and we got fear in the markets, we could see gold and silver mining companies come into play here. This is something to watch. I've got my eye on it. We've got XAU to gold quarterly ratio continues to be one of the charts to watch into the end of 2023. That's the same chart that I have. What he does is he grabbed these tops and he grabs these bottoms and he put in a falling wedge with an arc and a potential shoulder, head, shoulder, and a potential break right where we're at. It's the same chart that I'm looking at. Gold and silver mining companies are really cheap in relationship to gold, and gold has broken to the upside and is starting to run. If we see a massive run at gold because of fears of the banking system, we could propel gold and silver mining companies. If the physical metals get lean, we could see money start to run at the gold and silver mining companies. It could be a nice little, not a nice little, this is going to be a big setup here where the potential for gold and silver mining companies could vastly outperform the metal itself, and the metal itself could vastly outperform all the other assets if the right market conditions come ahead of us. And the market conditions that I foresee that happening is the uninversion of the yield curve, people getting scared and fearful of the banking system, and money rotating and running at gold, silver, physical metals, and the gold and silver mining companies. I'm not saying that's going to happen 100% for sure. What I am saying is the setup is there for that potential outcome to occur. Looking at Cuppy, he writes, I'm totally asking a hypothetical here. But has the Fed ever raised and then lowered rates in the same week? I do think it's funny. Tavi says, from inflation is transitory to the U.S. banking system is sound and resilient. But we've got banks all around us looking like dog poo. Interesting. Happy Hawaiian says, gold briefly just hit a new all-time high. They can't stop the flight into real assets, real money. It's only just the beginning. Silver to outperform too. And if we can get those gold and silver mining companies to break that downtrend line, oh man, we could see precious metals run to the upside and the mining companies outperform it. Fingers crossed. Coming on down, it says, so this is Grady. I like Grady. He's got really good charts and he's got a good head on his shoulders. It says gold is still holding the breakout as expected. One cannot play a resumed bull with a bearish mindset. That's why most missed the lows. Many called the top. Many called for ridiculous low numbers, plus bailed to get in lower. The right mindset, tools, and experience is needed. Again, we've broken out of this trend line and this pattern to the upside, and we are running. It is GTG, good to go. It's good to go. It doesn't mean it will be immediate, but it very well could be. Eric Nuttall, he says, it's a battle of falling oil inventories plus a very bullish second half setup versus the U.S. debt ceiling regional bank recession fears. Fundamentals losing for now. We remain bullish and believe the magnitude of summer stock draws will lead to meaningfully higher prices. I'm glad that he at least admits about this duo between these two forces, fundamentals versus the financial fears. That's really what's going on right now. And the financial fears, and maybe perhaps the liquidity, if it's a liquidity problem, will set up oil in a more bullish scenario because the fundamentals support higher prices, while the current short-term problems in the market can bring back the oil price. The setup there is that difference. That is what we look for in setups. We want this setup to get even more favorable. If you look at gold and you look at the gold to oil ratio, we are back up around 30 again. So we are very cheap for oil. I don't think that gold is going to go rocketing higher to like $2,500 a barrel. And I don't think oil is going to go down to $40 a barrel. Now, if that does happen, that is a setup of a lifetime, guys, because your oil to gold ratio is going to be ridiculously cheap, like anomaly cheap again. And that will be one heck of a buying opportunity if that were to happen. He says, second time this year that my family vacation coincides with a 10% plunge in oil price. Mercifully, for energy investors, my trip is over in 2 days and we rallied hard the day I got back the last time. What makes me think the sell-off is non-fundamentally based this graph? This is XLE to XLF, the financial sector versus the energy sector. And we're up here where the financial sector is in no man's land up there. So XLE and the oil companies were out of sync right now. And that can be an opportunity. I am not scared of this pullback. I actually want to buy a bunch more. I just don't have a ton of money at the moment because I already bought a lot of these companies and I did deploy it at lower prices than where we are today. So it was the correct deployment of capital. But I would like to buy more if I could. If right when I see that first signs of strength, I would buy into that strength, which we haven't seen yet, but I have a feeling it's coming soon. Investment wisdom, it says, to achieve long-term success over many financial market and economic cycles, observing a few rules is not enough. Too many things can change too quickly in the investment world for that approach to succeed. It is necessary instead to understand the rationale behind the rules in order to appreciate why they work when they do and don't when they don't. That is why I'm a hybrid investor of technical analysis and fundamental analysis and use ratios and market conditions. It's basically what this is very similar to that. Now, when you get these liquidity events like we are in today, the thesis that I have will not catch these short-term movements. It's not meant for the short term. It's meant for the long term. It's meant for the fundamentals. It's meant for an identification of long-term market imbalances of value. The short term is the short term. It's going to run into these problems as we increase interest rates. Unemployment's going to go up. That's the cycle that we're in. And you're going to have to ride through some volatility during these commodity bull markets. It's just the way it is for commodity bull markets. That is the cycle. They go up during times and conditions when we have more likelihood of recession and all these unemployment going up, et cetera, et cetera. How many rules should we be observing? So here's monster crude inventory draw crushes forecast down 4 million barrels. That's the demand side of it. So I'm going to leave it at here. I know it's a little shorter clip today. But that's what we see in the markets, guys. It's crude oil, demand, supply of the physical market versus demand, supply of the financial market. That's really what it is. And the financial market is overcoming the fundamentals. Gold, silver, looking absolutely fantastic from different time frames, short time frame, medium time frame, and a long time frame. That is the alignment that we look for. different time frames, all in alignment, and you've got the alignment of the gold and silver mining companies cheap to gold and gold cheap to other assets. This is a full alignment. This is like 6 moons and other planets all in alignment that happens like once in I don't know how long it is for that to happen, but the alignment's here, guys. And the way that you have to figure out how to allocate to these companies is it's up to you, but your allocation is infinitely important on where you deploy money. I don't think, I mean, if you want to outperform the markets, you're going to have to find the companies that can outperform. And then you have to be patient and you have to ride that volatility. And sometimes that's not easy. So if you're in it for a 20 or 30 bagger, you're probably going to have a 50% pullback at some point. And you're going to get gut checked, especially if you're up a 10 bagger and it goes back 50%. That happened to me multiple times in SM Energy, and it's happening again. And I'm holding on for the big long-term bull market. We're at a ratio of 30-1 for oil to gold ratio. That's historically cheap. That's generally when I pile into it. So these companies, they're not as cheap in the full alignment because we can have oil cheap to gold. Gold starts to rocket. Oil is probably going to follow it behind it. But we don't have as cheap equities in relationship to oil and natural gas. Natural gas is also incredibly cheap. The alignment, though, isn't as good as it was in 2020 in the oil and natural gas sectors. That doesn't mean that we can't have massive upside for oil and natural gas. The alignment for silver mining companies is pretty cheap. It's pretty good. It's a pretty good alignment. So that is one area I'm looking at. I'm not going to be getting out of my oil, natural gas holdings entirely, but I will be looking at some of these opportunities in the silver gold space. That's for sure. And I already have done it. I've already positioned in them some weeks, month ago or more when we were at bottoms doing these falling wedges. If you're part of the website, you know that. And I'm going to stick with it and hold on. I do not trade the short term. I'm a long-term investor, and I ride these ups and downs. It's pretty volatile sometimes, but I've done very well since 2020. I'm going to continue to deploy that strategy and ride through it. And sometimes, if you're a new investor, you're going to see your accounts go up and down. It's kind of gut-wrenching sometimes. 20, 30%, 40% swings going all over the place. We had a few companies go up a few 100%. Some of them have pulled back in recent. Some haven't pulled back that much. And that's what we're seeing in the markets. They go up, they go down, just like Peter Lynch says. And you have to know why you own those companies. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We do have a 5 p.m. Mountain Standard Time question and answer session coming, just as a reminder. We'll catch everyone there. And catch you next time. This is Finding Value.